Today, we are going over a case study about how you achieve consistent returns in rental properties that Greg has worked diligently to put together for you. And right now, it is time for you and me to do this. We're in the front nine, and it is live on Facebook for the Not Your Average Investor Show, Tuesday edition. I am your host, Pablo Gonzalez. With me, as always, the man that I love to call GC, because he is a genius concept creator. He knows how to generate cash flows. He's a great co-host, and his name is Greg Cohen. Say hello, Greg.
Hey, everybody. Great to be with you.
Great to be with you, buddy. And as we all know, we got the family in the house. Check in with me in the chat. I want to hear from you here. If this is your first time here, definitely check in as you see the rest of the JWB family checking in. And the way that we like to say it around here is, if you want to find out about owning rental properties in your portfolio, you have come to the right place. If you want to find out about the best property management practices for rental property investors, you're in the right place. And if you're just looking for an edge in the Jacksonville market because you're a real estate professional and you're looking for extra opportunities, you're in the right place. Next place to go is chatwithjwb.com, and we will give you a personalized attention call and figure out how it all fits for you. But right now, it is time for my favorite tradition, GC, is the roll call. You ready, buddy?
Game on.
All right, roll call time. John Hannon, good afternoon. Drew Barnhill, good afternoon. Carl Thompson, good morning, everyone. Jen Filson, welcome back, Greg. She says, I agree. Welcome back. Welcome, Jen. Good to have you on. Dean Curry from the beautiful Columbus, Ohio. Welcome back, Dean Curry. Leo from California. He's back. Good morning. Who else we got in the house? We got everybody saying hi to each other. We got Ken Moline, former star of the Not Your Average Investor Show, current star of Life. Welcome back, Ken Moline. Nadeem, hello, JWB family. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Welcome back, Marilyn. J. Renee Brooks, hello from Philadelphia, Pennsylvania. J. Renee, good to have you here. That is awesome. That is a new name, I believe. And that's what we got for now. Check in the chat. Let me know if this is your first time. I want to know if you're here for the first time. If you've been back a bunch of times, maybe give an estimate of how many shows you've been on. Bill Shields is back with a Buenas tardes, amigos. Good to have you, Bill Shields, and your bilingual greetings. I really like it. Yeah, that's right, Jay Renee. I knew you were a first timer. Good to have you, Jay Renee. I hope that you get to stick around.
Ask them how they heard it. Well, I'm asking you to ask them. Jay Renee, we would love to hear how you heard about the show. We're always super curious about how new folks are finding us. So let us know.
Yeah. Let us know. And, since it's your first time, this is a completely interactive show. We want you asking questions. We want you asking, Jay Renee got an email. That works. We want you asking questions. We want you interacting with Greg and I, as everybody else is. We want you making friends in the chat as well. There is a little trick to the chat that I think everybody has it figured out this time around. I think maybe Ken is only talking to us, but it is normally defaulted to only speak to the panelists and attendees. That means that only GC and I get to see what you're saying. If you want everybody else to see what you're saying in the chat, you got to change the little blue box above to everyone. And now everybody sees it. So far, everyone is doing well. And I say that because there is a lot of genius in this chat. We got a bunch of great rental property investors that know a lot about a lot more than me, at least. And then second is, if you want your question asked on the show, you want me to ask GC personally, my favorite thing is if you put it in the Q&A, which is a separate box. And I only ask that because the chat goes quickly. There's a lot of people putting in awesome input and making friends and having side conversations that I hope you take part of. But my eyes go cross-eyed when I try to keep track of all of it. So if you put it in the Q&A, I'm able to bring it up for GC over here. And I don't think I missed anything so far. Go to chatwithjwb.com if you want your own thing. And without further ado, GC, you wanted to put together a teaching session about consistency in rental income properties. Why is that?
Well, I think it's one of the most misunderstood aspects of rental property investing. It's consistency is the number one thing we hear as far as a reason to come to rental property investing. It's a reason people want to leave the more traditional investments in the stock market. It's because of the variability in the stock market, right? So, and they're looking for an alternative. They're looking for a solution, and they believe that it's rental properties. And it is rental properties, but not the way most people do it. There's a very nuanced point we need to make. And that's really why I wanted to put this case study together, put together some real numbers. I know we get great feedback when we take real client situations, real numbers, and share and be able to teach a point, but actually show what somebody has lived through 10 years of investing in rental properties, the good, the bad, the ugly. So we're going to go through that. And guess what, guys? I've got a lot of ugly to talk about today. I think that's where the big learning lessons are. So I wanted to make sure we could do that because this consistency is so critical. It's one thing that really lacks in investing overall. And I believe when you have consistency, really good things happen, right? Consistency of income leads to a lot of wonderful things in people's lives and a lot of wonderful outcomes. So we need to understand how to build this consistent rental property portfolio. And that's the focus for today.
Sounds good, man. So as we were preparing for this, you kind of told me there was a couple different layers. And the first layer is understanding if you're going to go ahead and invest in a turnkey rental income provider or go a step above and invest with a vertically integrated rental income property provider. What are the things that within the property, within the transaction, within one house that you should be looking for in order to mitigate for those fluctuations and that consistency?
Absolutely. There's like an entrance fee to get in the game is the way I think about it in terms of achieving consistency. And for a vertically integrated provider like JWB, who handles all aspects of the investment for you, there are certain things that we have learned that are non-negotiable when we put clients into a cash flow investment. And that's just basically setting the table. It's not going to ultimately get you all the way, but there's no way that you should be investing if you don't do a few of these things. And as far as this being vertically integrated and controlling all aspects of the investment, I thought we'd start at the very first aspect, which is acquisition, right? When you are buying your rental property, it needs to be in the right market and the right neighborhood, right? The right market is a market where you can have low prices and high rents, right? That's why a lot of investors come to a place like Jacksonville, because our median home sales price is below the national average and our rents are actually above the national average. Whereas, you know, if you go to a place like California, there's not a lot of whole rental property investors there. There shouldn't be there if they want to benefit from all 5 profit centers, because that's where you have higher than normal home prices and rents aren't going to keep up with the really high home prices there. So you got to choose the right market. And then in that market, you have to choose the right neighborhood, right? In that market, which is below the national median as far as prices, you then need to look inside that market and be below the median home sales price for that market as well. You need to be investing in below middle income housing. And the reason is because that's where you get the right rent to price ratio that sets you up for success so that you can have positive cash flow. If you're only investing with your eyes in the ways that the property looks on the outside, it's going to lead you towards the properties that look the best, that are in the best neighborhoods. And unfortunately, they will not be positive cash flow for you. So you got to invest objectively by the numbers, and you have to set the table right. And that starts with acquisitions.
All right. So that starts with acquisitions. What's next?
Well, construction would be next in the life cycle, right? So when you are buying a rental property, either new construction or renovations, we love them both. We happen to focus on new construction right now in the Jacksonville market because that's what the market is bearing. If you're investing in renovations, that can be a great thing for you too. I have many renovations in my own personal portfolio. But what you need to make sure is that you go into this, either if you're handling it yourself or you're working with a turnkey provider, that there is no deferred maintenance. Deferred maintenance would be, you think it's a good deal, but the AC is probably going to conk out in like 6 months or a year and you buy that property. Well, don't do that, right? Don't work with a provider who doesn't have upgraded materials all throughout the house, especially the mechanicals, because, you know, obviously that's going to end up paying you are costing you down the line. And it costs you a lot more than that. It's your resident experience that it costs as well. When you have to replace an AC and somebody had to wait 2 days, especially in the Florida sun, they didn't have AC, that's not going to bode well for you getting a renewal. And on top of that, you also need to work with a provider, or you need to do this yourself, and make sure that you use upgraded materials throughout the house. So I'm talking about things like flooring and paint, right? You need to make sure that you have a hard surface in the living areas of your homes, because people are going to be living there. The design behind this is that people are going to be living there for a long time. So you need to use materials that can withstand somebody living in there 4 years, 5 years, and still be in decent shape for you. Paint is another thing that we spend more money on at JWB than the bottom of the barrel paint. We use an upgraded paint because it requires less touch-ups. It can be touched up better and easier, and is more appealing when it is touched up. So these are these things. It needs to be withstanding a long-term resident stay, and no deferred maintenance from a construction perspective.
Got it. Makes sense. So, is there more on the construction side that you're going to?
Well, it kind of just dovetails so well into the property management part of it, right? Okay. So you then need to make sure, and this is all just baseline stuff, you need to work with a property manager who understands, appreciates, builds systems, and trains around long-term resident stays. Long-term resident stays are the greatest determinant of your success in rental property investing. It's very clear. If you have a resident that is happy and stays in your home multiple years, 4 years, 5 years, longer than that, you are going to have more consistency in cash flows for your rental property, and you're probably going to be more happy about your investment overall. If you go into this with the best numbers on the deal day one, and you accept 1 year leases, and you don't really focus on renewals, I guarantee you're not going to have a good experience. You're going to be like most rental property investors out there who get jaded, who get upset, who are underwhelmed, and then end up leaving the asset class. So long-term resident stays are a strategy. It has to be trained, systemized, and worked on all the time. Like, your property management team should have sales goals devoted around how many long-term leases they sign, and sales goals devoted around how many renewals they sign. If your property management team doesn't have that, it's going to bite you. So we focus on 2 and 3 year leases, not because it benefits the property management team, because it benefits the long-term investor. You don't get long-term resident stays with 1 year leases.
Got it. So to summarize, if you are looking asset per asset, you're looking at who you're doing business with in order to mitigate for consistency, right? Provide the most consistency. There is 3 kind of pillars there: acquisitions, the construction, and the property management. When it comes to acquisition, you're looking for that positive cash flow on the front end so that you're not dipping into your own cash flow in order to make it happen. You're looking for below middle income neighborhoods with low prices, high rents, and surrounded by job so that you have a constant stream of tenants, right? So that's on the acquisition side. You got to be thinking about that positive cash flow and the tenants. On the construction side, it needs to be built to defer maintenance, right? So looking at things you kind of shook your head there.
Yeah, let's say it a different way. So 2 things. There should be no deferred maintenance when you buy it, meaning no things that you know are going to break in the first few years that are major mechanicals. Don't accept that. And don't go into it for yourself doing that if you want to be a passive investor, right? So no deferred maintenance there. And then on top of that, you want to finish my sentence there?
Yeah. And then on top of that, you want materials that allow you that don't require as much maintenance or are easy to maintain, right?
Can withstand it.
To withstand it.
Yeah.
Very, very well said. And then finally, property management, right? What we've learned over time on this show is this idea that the more turns you have, the less attractive the asset becomes. Therefore, your property management team should be aligned with your own goals, and they should be incentivizing long-term stays, and they should be celebrating long-term stays and renewals and that type of stuff in order to keep it there. And it just so happens that JWB, as a vertically integrated provider, you all do all this, right? You acquire in these very specific neighborhoods. You are in line with the construction. You're also investors, so you know what materials work well. And for the property management side, you average resident stays of over 4.5 years. So, that's kind of the formula for success.
And we do all of that because it is the very baseline of how to achieve consistency. And consistency is the number one reason people are looking to looking to rental properties and coming from the stock market.
There you go. So that is for our friends that are here listening. If you are looking in other markets, right? Because JWB is only in Jacksonville. Those are the questions that you want to be asking, right? Like those are the things that you want to be looking at an asset. Those are the things that you get with JWB in Jacksonville. I also put up a poll of where you learn, where do you like to learn about real estate? I just put that up here. We've only had a little bit under 50% of people respond. So if you're listening to the call right now, check your screen. I would love to hear where you learn about real estate. So far, poll position is podcasts. 11 out of 16 people that have responded listen to podcasts. After that is YouTube. After that, it's books. So would love to get the final numbers. I'll share it with everybody. And what we are doing that poll for is because we want to bring all the favorite people that you're learning from in order to have them on the show so that you can meet them, right? Like part of the reason why we do this show is so that you can interact with the people that you want to interact with. We've got that part figured out as far as other investors like you. We have a bunch in the chat. We have a bunch in our Facebook group, jwbfacebookgroup.com. That you can interact with. But as far as like celebrities and educators and stuff like that, if you're populating here, the books, the podcast, the YouTube, put in the chat who you want to meet. That is the head of that YouTube channel, the host of the podcast, the author of the book. And I'm going to sick Greg on him. He's going to bring him in here for you. Yeah, I also want to call out Ken Moline puts, it's been 2 years since we visited Jacksonville, would like to visit again. And so what I wanted to read was he put that he is celebrating his 2-year anniversary. We're celebrating our 2nd anniversary of JWB home ownership this week.
Wow. Congratulations. That's amazing. So thankful for your trust.
Yeah, very cool. And I'll never forget Ken's episode, right? Like Ken blew your mind with his like super advanced tax strategy and the idea that he had taken this reverse mortgage to just completely change his retirement experience was major eye opener for me. So Ken, super pumped to have you here, buddy. All right, GC. So we talked about within the property. If you are looking at a provider, if you're looking at a property, the stuff that you have to look for, but there is more in order to actually achieve the consistency that you call consistency. Tell me a little bit about that.
Yeah. If you do all those things that I just mentioned, guess what? You're still not going to achieve consistency on an individual rental property. No property management company, no vertically integrated turnkey provider should be telling you that even if you do those things on an individual property, it's going to be consistent. And I think this is one element that people they don't know this going into rental property investing. You only learn this after you've owned, a few hundred for 15 years like I have, right? You've only seen thousands of clients actually own rental properties. And you've seen how folks, that the expectations going in for other people might not be how it actually plays out. But the reality is that an individual rental property is not by itself going to be consistent, even if we do those things. You got to do those things, but an individual rental property is not going to be consistent. What happens is, and what most people don't understand, is that when you're renting out your rental property, right, you build in your expectations of rents coming in, you build in your expectations for tenant placement fees that you have to pay, build in your expectations for maintenance costs and vacancy costs. Well, when your home is occupied, you are blowing your returns out of the water, meaning you're doing much better than you expected, right? People tend to think that when it's just rented, you're just performing like normal. But when it's rented, you're overperforming. And then on the other side, when you have an issue with your rental property, which will happen, early move out, the dreaded eviction, maintenance item, you name it, it will happen. When you have a move out in a year, your returns are negative. So the variability on an individual rental property is actually quite substantial. And people come in thinking that it's all going to be steady state. My home is always going to be rented. It's just not the case. And this is what I'm convinced is the rub, right? This is why people generally have a poor taste in their mouth when it comes to rental property investing, because they're not understanding this cycle, right? No matter how good of a property manager you have, they're not going to keep your resident in your home forever. All right. And so you're going to have some great years where you're above expectations, and then you're going to have a down year, right? So how can you create a portfolio that can withstand this challenge, knowing that the highs are high on an individual property and the lows can be low when there's a bad year? How can you build a portfolio that can be consistent? Well, that's what JWB has spent our entire business livelihood constructing and building and molding and training and helping. It's because you can achieve a consistent portfolio that is comprised of individual properties that are not consistent, which is really special and cool if you understand how to do that.
All right, I get it. So by diversifying, I mean, it's rule number one of investing, right? Diversification, right? So even within the asset class, if you can diversify the different houses that you own, you add more sample sizes to it, you can gain more consistency. And you're talking about right now consistency from a year to year level, right? Like you're talking about, you might have a down year surrounded by a bunch of other good years in the singular property. So the best way to mitigate it is to have multiple properties, and generally that same down year is not going to correlate. So then that kind of stabilizes. Is that kind of what you're saying?
Yeah, exactly. Right. I mean, the idea of diversifying within your rental property portfolio it's not rocket science, right? Right. If you have multiple assets in your portfolio, then you are going to have some that are doing better and then some that have a down year. And ultimately you're going to get to the steady state of hitting your returns is the way that it's built. This is more coaching for your mindset, right? Many people get really upset when they're investing in rental properties and there's an eviction or there's a move out. And guess what? I get upset too. I don't like it. But the missing piece for a lot of rental property investors is that if you have a negative item that happens on an individual property, you need to be okay with it. If at the bottom, your total portfolio is hitting your overall returns on investment and is consistent year over year over year. And that's a leap that a lot of rental property investors can't make, right? I've seen a lot of rental property investors, again, traveling the country and talking and speaking and working with rental property investors. I see a lot of rental property investors that get so emotional and frustrated about an eviction. They're like, I'm done with this property. But if they had looked at their overall portfolio over the years, there were probably 4 years or 5 years that surrounded that 1 year that had way overperformed. And if you looked at exactly how the cash flows and the returns had performed over the long haul, it was actually hitting return expectations. All right. So it's this lack of understanding that you're overperforming when your home is rented, and this lack of ability to look at the total portfolio and not get emotionally invested when you do have a negative item that happens. And the worst thing that can happen is if you get emotionally attached when there's a negative item that happens on an individual property, and it causes you to make an emotional decision to maybe sell that asset and maybe write off this asset class. Now you really have made some decisions that unfortunately can really harm your financial future.
That makes a lot of sense. So what I'm hearing from you is that a lack of clarity in what your numbers are doing and performing on a day-to-day level can cloud your judgment when you have a bad emotional experience in a short-term way. Is that kind of where you're at?
Yeah, I have seen that many times.
Yeah.
Mm-hmm.
So what's success then? Is success not having maintenance? Is success having more good days and bad days? How many good days than bad days, right? Can you kind of like define success as far as investing in rental properties?
Yeah, the easiest way to define success is through your entire portfolio. Are you hitting your return expectations? And is it consistent year over year over year? Your entire portfolio, not on an individual basis, on an annual basis, right? Because some years are going to be way over and some are going to be below. But on an entire portfolio, that's the way to manage your expectations on rental property investing. And with this, we need to recognize that there is a requirement to add multiple properties to your portfolio if you want to be consistent, right? If you're getting into rental property investing and your plan is to own one rental property, that's okay. But I need to share with you that it's not going to be this consistent asset class for you. Again, it's going to be overperforming hopefully for a number of years. And then 1 year, you're going to not like that investment because there was an eviction or whatever. There was something negative that happened and your returns were negative. So if your goal is to be consistent in your rental property investing, you need to go into this eyes wide open and know that you need to have multiple properties. And what we coach and train and mold our clients to expect is that you need to be at 3 properties by the time your first resident leaves. It's kind of our standard rule of thumb. Now, that doesn't mean you need to buy 3 properties right off the bat. But if I don't share that with you right off the bat, that you need to be investing and have plans to be up to 3 or more properties at some point, that means that I'm setting you up for failure because I can't be that consistent performer. JWB cannot be that consistent provider for you. So the average resident length of stay for JWB is 4.5 years. So when clients come on board with us, we go through our buying plan with them before we actually buy properties together, right? Before we allow them to actually purchase properties, we actually plan this out. And a part of that conversation is talk to me about what your ultimate goal is. We help them break that down into the number of assets they need in their portfolio. And if that number is 1 or 2, we're going to have a really healthy conversation to understand what they're really trying to get out of this asset class. And if it's consistency, we're going to be open and tell you, listen, with 1 property or 2 properties, it's probably not going to be there, right? And we'd rather have that conversation up front. So 3 properties has shown for us to have much less variability in portfolios versus 1 property and even 2 properties.
Got it. And, kind of the proof is in the pudding of this is what you preach. We have, who do we got? We got Rosalind Riley saying that they just closed on their 3rd rental property from JWB yesterday, and they're excited.
Congratulations.
Thank you, JWB. Very cool. Drew Barnhill is saying that he is closing on number 2 and 3 in November, which is awesome, Drew. That's really
all right,
cool
Drew.
to hear. I'm at 2, looking for my 3rd, right? Like I know that you've beat this into me as well. So if I only have enough cash for 1 right now, is there a way to approach this? Like if I have enough cash reserves to handle a downswing and I know for sure, is that one way to look at it? Should I just not acquire it if I don't have already this plan for 3 in under 4 years? Can you talk me through that mindset and then we'll head into the case study?
If you have enough resources to buy 1 rental property and through the onboarding at JWB or whoever you're working with, you've determined that it's a good fit and it's the right thing for your goals and you have enough to buy 1 rental property, this is the very best time to buy 1 rental property right now. And you should do it and be very excited. Right? Now, 4.5 years is a long time, right? Even if you brought no additional capital to the table, there's a good chance that if you sat down with my team, we could have a pretty good idea of how you could get additional capital either from your investments or from other sources of capital or from helping you raise money that you could actually get to multiple properties by the 4.5 year mark, right? So I don't think we've ever sat down with somebody who had enough money to buy 1 rental property today and had the goal and the intention and said, I want to get to 3, but I don't have the capital figured out just yet. I want to get to 3 sometime in the next few years, 4 years, 5 years. We have never had a conversation where we're like, you know what? That's not going to work. It's not a good fit, right? That's what we do. That's how I started. When I was 23, I didn't have capital, right? I mean, I hoped that I was going to get, bonuses and whatnot when I was working at Johnson & Johnson and all of that. But I also looked at how the investments were growing. I looked at my retirement accounts. I looked at ways to raise money. And so we're masters at helping folks find capital if you give us enough time. So anybody who has 1 rental property should take this as preparation for how to be successful in this asset class. And you should be excited about buying 1 property. And JWB loves to work with clients who bought 1 property right off the bat. Pablo, you and I work together. You started with 1,
Yep.
right?
Yep.
And that's a wonderful thing. Now, but the thing is that what we want to help clients understand is that, if you have the capital to do 3 and you only want to buy 1 and you think that's the max for you, well, that's when we get to have a conversation with you and say, you know what, that doesn't seem like it's a fit. Right? So it'd be more likely that we would have that conversation if you had the money to buy 3 today, had the money to buy 3 in 5 years, and you said you didn't want to. That would be more of a trigger for us to have that deep conversation about really, are we aligned here?
Yeah. Like, what is this asset class all about? Do you have the right expectations? If what you want is just like toe in the water, one house to tell people you got one, right? That's kind of the move.
Yeah, yeah. And for us, it comes down to a client service issue, right? Part of the reason why I wanted to share this today, and we have so many of our current clients on the show here, and thank you guys for sharing your assets, the properties that you own, the ones that you're continuing to acquire. That means so much to me and to my team. So thank you for sharing that. Right. One of the things I want to do is to make sure that clients come in with the right expectations, because there's nothing worse than when you're performing for a client from a numbers perspective, the return on investment is strong. But when you have a negative item that happens, when you have that move out, that early move out or whatever, and the client's upset, and I'm convinced that if I do a better job in instances like this of preparing clients before they become clients, right, and helping to reinforce this with our clients, that I can create more successful outcomes where we can hit our returns and clients are prepared for the good days and the bad days and excited even when something non-exciting happens.
Makes sense, man. And I want to touch on something you said, this idea that if you only have enough for one property right now, it's never been a better time to buy that one property. That's something that spoke to me, right? Like, I have grown to understand, like Drew Barnhill is putting in the chat, with today's historically low interest rates, it's a tremendous opportunity. There's also the idea that right now the market is appreciating well above the average. So you still have plenty of runway there based on our stats of month of inventory and how quickly the velocity of real estate is moving in Jacksonville for the asset to overperform when it comes to appreciation. But Raj Bantu, before we get into the actual case study, because we're not just here to give advice in the middle of the year, we're going to go through some numbers and we're going to teach you a little something. But Raj Bantu's got a question. Residential real estate appears to have slowed down a bit in South Florida. What is the situation as far as like days on market and inventory and whatever in the Jacksonville area? You want to kind of give a little update on that?
Yeah, absolutely. Thank you so much for that question. And this is going to become more and more of a theme in the media over the next year. And it's what I want you to pay attention to. There's always a couple sides to the story, right? For those articles and for those stats that you're looking at, Raj, I would imagine that they're talking about the number of home sales. Okay. They're not talking about pricing, right? Pricing continues to go up. The number of home sales is slowing. Okay. And also pricing is going up, but it's not going up at the 15 to 20% annualized appreciation rate that we had last year. So if you're taking 2/3 of those points and you're talking about the number of sales slowing, and you're talking about the rate of growth slowing for appreciation, you're right. But overall, our appreciation rates are higher and higher than historical averages today, and they're still higher. So what's happening here is the number of home sales is slowing because of a couple of things. The number one thing is that there's just no inventory out there. A year ago, there was a lot more inventory. There was 8,000 houses on the market a year ago in Jacksonville. There's 3,500 on the market right now. So you're going to see the pace of sales slow. And if you want to write an article about the real estate market about to crash, you could talk about sales are slowing, right? You're going to see a lot of those articles. I'm going to tell you that, right? But the reality is that because inventory is so low and demand is still really high compared to inventory, we still have very low months of inventory. Haven't pulled the numbers in the last month just yet. I'll do that here pretty soon. But last time I checked, it was in the ones. It was under 1.5 months of inventory. I mean, that's insanely low. If you read any articles on Google about the inventory shortage out there right now, just saw an article. My dad just texted me before I came on to the show, and he said, check out this article. I think it was from CNBC about the 5 million home shortage that the U.S. has because of underproduction of building for the last decade. So you have this very low supply of inventory. And when you have low supply of inventory, especially in markets that are still affordable, you're going to see home prices continue to rise. So I have never been more confident that home prices are going to rise over the next 6 to 12 months. But at the same time, be prepared. You're going to see a lot of articles out there that talk about the rate of homes selling. Some other point here is another point to take into account is last year, 2020, was an anomaly. There was not the normal seasonality that we normally see. So at the end of 2020, you had these ridiculously high number of home sales, which again, if you want to write an article for how home sales, are slowing now, you go year over year data, you're going to start really high when you didn't have the slowdown towards the end of the year that in 2020, things were on fire towards the end of the year. It's going to make this number of sales today, which is still historically high, it's going to make it low. And you can write an article about that. You're going to see a lot of them. So I love that question. I hope I did a good job of kind of explaining that nuanced point of view there.
That was awesome.
Yeah, cool.
Yeah. Like that was super eye-opening. Me as a marketing guy understands the value of a shocking headline.
Yeah.
Right. So the idea that the reason why you're going to have this incongruent feeling based on what you're reading of like, if you can manipulate data a certain way, then I can upset you enough to open an article. And that is how our media system is incentivized these days. But the truth of the matter is, the absolute numbers are X and the supply and demand dynamics are Y. And what you really care about is the supply and demand dynamics, looking a layer deeper. And real quick, Marilyn Cotterman, speaking of numbers, just wants to know currently, what is the average time for rental clients before they move out?
The average time for residents before they move out?
Yeah.
4.5 years.
4.5 years.
Yep.
All right, cool. Got some good commentary. By the way, the chat's been awesome today. Just everybody's talking about the next meetup that's happening in December 3rd. I love seeing the interactions of how everybody's actually gotten to know each other IRL in real life and how everybody's talking about this stuff. It's really just warms my heart to see this. And then there's Drew Barnhill with great stats and great stuff coming in saying these stories are prevalent because the 2006, 2009 crash is still at the forefront of everyone's mind. But that is precisely why that scenario is unlikely to happen again, because people are still fearful. All right. Good call, Drew. Let's get into this case study. GC, it's 1:08, man. So we got like 20 minutes to get through this case study. I think that we skip over the white caps here and just try to contextualize stuff for everybody of everything you just explained.
You have free reign to stop me and move me on to the next point, because I just love this stuff and I'll just keep talking. So there you go.
I know you do. So, all right, we're talking about Sean. Tell us about Sean, GC.
Sean's a good friend, actually a family friend. Sean started to invest with us in 2012. Back in 2012, we were 6 years into our business and really before we started to hit our stride. So probably only family friends were the ones that were investing. Us and family friends and Jen Filzen, by the way, who became a family friend, investing with us in 2012. So Sean is a wonderful family man. I know his family very well. And he came to us and he said, I'm interested in getting out of the stock market. I want to create some passive income. I want to create some supplemental income as I get towards retirement. I want to build this income stream to be able to do more things with and for my family. When he started his passive income goal, you can see it there, was $1,500. For those who are new to the show, for Jay Renee, I'm not sure if you've been a part of the show or have spoken with my team yet, but one thing you have to look forward to is we're actually going to help you determine what your goals are. Before you buy properties, determine what your passive income goal is. And we're going to help you understand how many rental properties you need to put into your portfolio in order to accomplish that. That was the original goal. $1,500 a month was what Sean was looking for. As you can see here, he's grown his portfolio to 6 properties. That 6 properties will produce a lot more than $1,500 a month. So that was the original goal. And he, of course, has continued to invest more and more and more. I'm going to show you why here in just a second. For him, he front loaded his purchases to get all 6 early on and completed his portfolio. He sectioned out a certain amount of money that he wanted to put in this asset class, brought it from a different asset class and brought it over and said, this is now going to be X% of my overall portfolio. And that's a very common strategy for clients when they come to us.
Right. Cool. So his overall strategy is here. Then this is his track record of purchasing homes. You want to talk through that real quick?
Yeah. Again, this is just, this is something that will help people understand the type of reporting that is available for you at any point in time. If you're a JWB client, you get to see some pretty cool things over time, right? These are his 6 properties. You can see the actual purchase dates, the actual purchase prices. For all of our folks who are buying properties today, right, you're going to see these purchase prices of $102,000 and $97,000 and whatnot. And, we're going to look back and we're going to say, geez, I wish I would have bought more in 2012. Well, my prediction for you is that 10 years from now, you're going to look back at the prices you're paying today and you're going to say the same thing. Except your interest rates, if you look over there, 4 or 5 columns in there, look at those interest rates. I remember working with Sean to buy these properties, and we were talking about how interest rates in the 4s were just unbelievable. I mean, that was probably the biggest motivator for Sean, if I can remember, right? 4.75%, 4.38% on his loans. Well, now you can get loans substantially less than that, right? I just more credence that interest rates today are lower than they are going to be in the future, because 4.75% for a rate is unbelievable. When I started to buy my rental properties, my rates were in the 7s, and all 30-year term. It's great to be able to borrow that money for 4% or 5% and to keep that in place for 30 years. If you think about wealth creation, your ability to borrow money at 4 or 5% and earn more than that should come pretty naturally to all of you who are on the show right now. And doing that for 5 years, 10 years, 20 years, 30 years, that's how you create generational wealth.
There you go. Drew's in the chat talking about he's getting at 3.5% or better. And by the way, when you're talking about this whole like generational interest rate stuff, you're basically saying this is why you're going so hard at this idea that right now is the time, right? Like that is just like the sense of urgency of like, if you can lock this in before interest rates go up, it represents this special opportunity. And I contextualize it as, I knew that I wanted to be in real estate going forward. And I was going to take a little bit of extra more time to buy rental properties or to get into this asset class. But when you painted that picture for me over the last year and a half was the reason why I mobilized and bought that first property, and B, sold some Shopify stock that I crushed, Peloton stock that I crushed with, and decided to move it in here. Cause at the end of the day, I will be in the market later on too. I just wanted to get in during this like specific time, right? So when we're talking about interest rates in this period of time where prices are still relatively low and interest rates are unbelievably low, that's what we're talking about. It's just like time to action, right?
Love it. I mean, what you did is you took a certain amount of money that you could probably long-term section to be in real estate. And you said, wow, this is a special opportunity. Let me put that money into play now in real estate. And then I'll go backfill more and more of my overall financial portfolio with stocks, bonds, mutual funds, many more traditional asset classes, or maybe other things, right? But it was like a special opportunity. And that's what we love to do, especially in our buying plan conversation. A lot of that is like, okay, let's understand the pile of money that you want to bring to this asset class. How can we take that same amount of money that you've already been excited about putting into this asset class and make it grow 3 times as fast? And that's what we can do.
Makes sense, man. All right. So what are we looking at here, GC? This is ROI per property, 2014 to 2021. Talk to me.
So when I was talking about the ugly stuff, right, I want to show you, this is Sean's actual returns on investment per property from years 2014 to 2021. This does not include home price appreciation. This includes everything else. So your net rental income, your tax savings, your principal pay down. It includes all of the costs, including maintenance costs, vacancy costs, tenant placement fees, all of that it includes. So this is what it really looks like in a number sense to be a JWB client for 10 years. And this is just the last 7 that we have here. All right. And these percentages should dictate to you, right? Did we overperform or did we underperform? And in my form, true to my form, I focus on the worst parts of rental property investing because I want to prepare you appropriately when you get into this asset class. So what I've done is I've highlighted the years for each property where we underperformed and sometimes grossly underperformed, right? Yep. And I think this is important because as a rental property investor, you need to be prepared that these negative things are going to happen. And each year, if you own 6 properties, it's going to happen probably once, twice. Sometimes you even have multiple that happen in a year. But generally, if you average this out, it comes back to that 3 property rule. That's why that 3 property rule is in place. You have 3 assets. 2 are going to be overperforming. 1 is going to be underperforming. And those returns are going to even out and hopefully slightly beat what you were expecting when you initially came in.
There you go. And we're going to get back into this slide, right? But we just wanted to show this visual here of, you see all the yellow, those are years that properties underperformed, and you see them stacked in different patterns. but when you look at the overall performance of the portfolio, it is largely positive, right? That 2014 year was at just 2%. And then 2015 and on, it's 15.8 plus, including some years that were, 30.63 and all this other good stuff, right? So just wanted to clear up this idea that I wanted to give away the ending of the story so that we don't get too distracted on like, did this actually make any money or not, right? But as we go back here, you want to kind of talk me through some of this stuff, GC? Like, how should we look at this chart, right? Like I see one year where 4 out of the 6 kind of like weren't great. I see another year where 2 of them weren't great. And then after that, it's like one of them wasn't great per year, but then there's a couple of years where everything looks really awesome. You want to talk to me about that?
Yeah, absolutely. So I think let's take a look at the most negative items, right? So 2019, property 3 is a good example, right? Again, it's surrounded by a lot of positives, but at the end of the day, this was a tough moment for Sean as an investor on that specific property, right? Now, that property had a property turn of $3,000, cost $3,000 of his money to put back into shape. That's more than the average. So it was a more costly turn than we expect. And that property took 5 months to rent out. The average amount of time it takes for JWB to rent a property out is 40 days. It took 5 months to rent this property out. Now, I share this with you in full transparency. I want you to see what can happen because I want you to be able to handle it. But at the end of the day, not normal, but it can happen, right? So in this worst case scenario there in 2019, if you don't have the right mindset, and this is something Sean and I talked a lot about early on, right? If you don't have that mindset, you could have a property where you have a 5-month vacancy and an above average property turn. You say, oh man, that's it. I'm throwing my hands up, right? I'm done with this one, right? But if you're not looking at a portfolio, if you don't have access to information like this, you could be making a really poor decision. One of the things I want you to see is that at each one of these really negative events, usually it's surrounded by some really overperforming years afterwards, right? If we're looking at 2019 property 3, negative 24%, it's surrounded by 27% in 2020 and 35% in 2021. Why do you think that is, Pablo?
Because it overperformed those years? I don't know. Oh, because
Yeah.
it was fully rented out and it didn't have a vacancy.
Exactly. Fully rented out with a long-term lease and it didn't have a vacancy, right? So when I talk about this individual property being an inconsistent asset, it is, right? And each one of these properties, right? The highs are high and the lows are low, right? So, and then the other thing is when you have a negative item, you usually are surrounded right after that. You have 2, 3, 4, sometimes 5 years of above average returns. What this should communicate to all of you is that if you don't have a strategy of having long-term resident stays based on long-term leases and renewals, you don't have a shot, right? Look in property 1, right? So 2015, we had 6%, not a killer year, not a dud for a year, right? But right after that, 31%, 31%. In 2018, right? 5%, not up to expectations, not the worst thing. But right after that, 32%, 35%, 35%. In 2016, property 2, right? We'll go to 3% for that return right there, followed by 35%, 35%, 23%, 33%, 35%. So I want you all to see this is the life cycle of an individual property. And there's nothing that property manager can do to eliminate that down year eventually. Like your resident is going to lose or to move out. But there's a lot that they can do to make sure that between those down years, you have 4 good years or 5 good years. Because if you only have 1 good year afterwards, it's not going to be enough to offset and hit your overall return on investment.
GC, when I look at this chart, I think of the conversation we had last Thursday when Brandon was the guest on the show. And he was talking about this idea that every one of these properties represent a chance to get on base, right? Like getting on base means you're going to get home eventually. Some of these properties are going to be singles and doubles. Some are going to be home runs based on what the forecasted ROI is going to be. and you're just not really sure which one. So it's really just about getting people on base, because eventually they're going to get home. And when I look at this, I would imagine that most of these properties had a similar ROI and outlook, because I know that for JWB, they're all widgets. You're selling the ROI, you're selling the cash flow, and it's always really standard. And then you look at, this one that had all these years in a row overperforming and one bad one. Then there's one that had 3 down and 5 up, and then, so you see this variability, and it's really just about kind of like getting in the game, being open to the positive stuff while allowing for that mitigation of risk and consistency to do its thing over time.
You're absolutely right. Get in the game, make sure that the assets pay for themselves, and then hold on for a full market cycle so you can benefit from all 5 profit centers. Because keep in mind now, this is all profit centers, not including home price appreciation, right? Do you think that that has had a significant impact on his returns, knowing that he invested in 2012? And since then, our appreciation rates have been much more than the historical average. Of course it has, which we'll get into. I'm sure you all would have assumed that I would shed some light on that.
I would assume that there's a slide somewhere around here. Is this it? No, this is total annualized investment.
Yeah, but this is important. I just want to shed light on this. So
yeah,
this is that portfolio mindset that I challenge all of you to have with your rental properties. Sean has this. It served him very well. When he had a negative item, when he had, negative 24% returns in 1 year, he didn't call me up and say, Greg, I want to sell my portfolio. He said, you know what? That's going to happen sometimes. What's my overall portfolio return? Are we hitting return expectations? And we are, right? So this 19.47, that takes every property, the weighted average annualized return, which is something that we produce for every client on a monthly basis, so that you can see, are we hitting the portfolio annualized return on investment expectation? As you can see, when Sean made his investment decision with us, we told him to expect about an 18% return. When he bought these properties in 2012, we are at 19.5% returns. Again, not even factoring in home price appreciation yet.
There you go. And now, by the way, Ken Milleen had just asked if this included home price appreciation. Oh, well, we're still not. There it is. The total with home price appreciation. There you go. 27%. Pretty significant.
Yeah. And, your net rental income right there, $127,000 over 10 years. That's like your dividend income. It's probably what you're not getting in the stock market. So that by itself, incredible. Takes into account all the expenses, any fees, any tenant placement fees, property management fees. So that's that. Your total return right there, that 257,000 and change right there, that includes your tax savings and your principal pay down. And if we take home price appreciation there on top of everything else, the overall return on investment, 27%. His money has been working at a 27% return year over year over year for Sean. And he also achieved passive income and consistency in the face of all these negative items, even in that 1 year in 2014, right? So the greatest harm is if we hadn't had this conversation early on and Sean didn't know this in 2014. What if he had thrown his hands up and said, man, I'm done with this asset class, right? That's where a lot of rental property investors find themselves, because they don't understand how consistency really works.
Got it. There you go. So Raj Bantu has a question. So what's the reason it took 5 months to rent? Like, why would a house take 5 months to be open on the open market?
I don't know. Hasn't happened very often. I didn't go back and look into the specifics on it. Yeah, I don't have a good answer for you on that one. Can it happen? Yeah, we manage over 4,000 rental properties. It can happen. I don't remember the last time that it has happened. Hasn't happened this year for sure. It hasn't happened in years. Sean might be the last one that happened too. But I like to show you really the most negative things that I can show you, because we spend enough time talking about the positives here. I just think there needs to be a balance. And, the question that you should be asking yourself is, can you handle a 5-month vacancy on one of your rental properties and still be excited if your overall return expectations for your portfolio are being hit? Can you do that? And if you can, then you're going to benefit handsomely from this investment.
Makes sense. So either by having cash reserves or by having multiple properties that pay for it when it's down, you want to build yourself up to be able to handle these wild swings. And what you're showing here today is the outlier terrible scenario that still turned out pretty good when you look at this 27% ROI on your money, $127,000 in net rental income, and $257,000 total lifetime return. Greg, I know that you want to hit on something we talked about. I don't know if it was last week, the week prior, but just a breakdown of the different profit centers and how it affects. You want to talk about that real quick?
Yeah, this was a slide I put together, I think, last week when we were talking about buying and selling or buying and holding. And I was sharing with folks that, many people focus on cash flow only when they're making their decision, but they're missing the big point of rental property investing. Cash flow is incredibly important. It's necessary to buy a positive cash flow investment, but your greatest return on investment is actually going to come from something else other than cash flow over a full market cycle. And we showed a slide that was very similar, right? On a normal JWB property, over 60% of your return on investment should come from home price appreciation if you invest for a full market cycle, right? So it always just kind of surprised me when we have clients or potential clients that would come to us and say, I'm only paying attention to the cash flow. You're missing the big deal. So I went back and I looked at Sean's actual portfolio and I broke down what his percentage of returns would be by the different profit centers. And here's what you see, right? Cash flow is 18%, tax savings 7%, principal pay down 11%, and 64% coming from home price appreciation, right? If you're not paying attention to the market that you should be investing in, that it's a growth market, and if you're not planning to be in for a full market cycle, you are giving up the biggest part of the pie when it comes to your return on investment.
Good stuff, GC. I think that was really illuminating. I liked how you kind of went through all the different misconceptions in the first part, and then we showed it on the back end of it actually happening in real life, tying it into the call from last week. I think it was a nice closed loop of information. As we like to say, if you came here to find out about learning about rental income properties, you came to the right place, right? We also talked about property management practices for rental investors. You're in the right place. And we talked some market education. You're in the right place. If you like this stuff, go to chatwithjwb.com and just start that conversation of like how you get it into your portfolio. Like I did, like so many of our friends in the chat came in. Thursdays, we have the JWB Rental Income Property of the Week.
Week.
So this Thursday, we're going to go back to the same show. Greg is back. He's taking a break from his professional golf tour, and he's going to talk us through a specific property and all the different profit centers, and we'll have an interactive discussion like we always have and make it illuminating. I would love challenges out there. Bring us a deal that we can break down for you that isn't ours so that GC can examine it and we can look through somebody else's pro forma and we can tell you kind of like what to ask and the things that you need to know. And we'll give you an expert opinion, whether it's a good deal or not, but that's 12:30 on Thursdays. I want to give a shout out to, it's not every day that we have somebody new join us and be so active in the chat and be such a part of the community. So Jay Renee, it's great to have you. I hope that you become a fixture here and let us know if there's anything that we can do to make this better. If there was something else that you were coming to look for, reach out to us. We'll get you the piece of content that we made in the back, or we'll make a new show about it because that's what we're here to do. We're trying to provide as much value to the community as possible. Hope that if you were here on this call, you're part of our Facebook group, join us there. Over 3,000 investors, just like everybody, just like you, that is out there trying to make a difference and grow long-term wealth. A lot of wisdom, like the stuff that you see here in the chat. I learn as much from the chat as I learn from just about any other guest that we have on the show. So good one this time around. GC, I want you to know that I'm just messing with you about the whole golf thing, man. I love it when you take a time off. I know what golf means to you. I think it's funny to drive this whole jaded lover conversation. I think people find it funny, but I'm pumped that you were having a really, really good round. I'm sorry that you didn't break it into the 70s on such an epic course, and I'll leave you up for
you know what? That was the only thing that was holding me back. I would have been in the 70s if I thought that you were, really the wind beneath my sails instead of, voodoo doll, putting a cushion and putting a pin in me or something. So I got that going for me now. So we're good.
I want you next time around. I want you to make those long putts, buddy. last thing I'd like to say is that we never take it for granted that over 30 people took an hour out of their day to hang out with us on this call. I just find it incredibly gratifying to think that we're putting out this value. And it's thanks to the people that come and ask the great questions just like you. So we hope to see you on the next call. GC, I'll give you last word and then we'll get out of here, buddy.
Echo those same sentiments. I was talking with some folks. We were talking about how we're going to grow the show because, we think we have something that people really enjoy now. And I was saying, we have, 40 or so folks that show up, and they're like, 40 people take an hour out of their day every week to do that. And I'm like, no. They do it twice a week, Tuesday and Thursday. And they're like, wow, in the middle of the workday? I'm like, yeah, our community is amazing. And I'm like, yeah, they light up the chat, and we have these off, in IRL, in real life, meetups and whatnot. And they're like, man, that's like Tony Robbins stuff, like right there. They're like, you usually have like a subscriber base for like 10 years before you can get that many folks to come and enjoy and be a part of this community. And you all have independently decided to do that. And it means everything to Pablo, myself, the hardworking people who are behind the show, on our marketing team, on our sales team, on our service team, everybody at JWB. So a very, very heartfelt thank you. And also an open invitation. We would love to invite more of you to be on the show, especially on Thursdays. We feel like the property of the week is a great opportunity. We've had a few guests that have been here. I know Drew was here for a Thursday when I couldn't be here. And we would love for all of you to be a part of the show. If you're a JWB client and you want to come on Thursdays and be a part of the property of the week, we would love to have you. So an invitation will be coming through email to you sometime. This is a little premature. Maybe over the next month or so, we're probably going to send it out. But if you would like to be a part of the show, we have some openings in November and December. And if you'd like to be a part of the property of the week, we would love to have you. So you can just reach out to your service teammate if you're already a JWB client, or reach out to Pablo or I, and we would love to have you. So thank you guys so much. And, we'll catch you on Thursday. Can't wait.